this happening, about another crash happening. It's just not as likely, which is why I put on this slide, housing could be a V recovery, meaning we might have already hit the bottom and bouncing back. Now, don't take my word for that. Please only use these slides to decide for yourself what the future holds. It's a very important decision to make, because if you buy something today and the market does crash, I don't want you coming back and being mad at me. But if we're having a V and we're right here and the market takes off, well, you need to be aware of that too, because it may be that it gets more and more difficult to get in the future. The reason I think we're in a V is simply what I said earlier. The amount of money that the Fed is pouring into the economy is reason enough to think housing is going to be in a V. That's exactly what happened last time. And when $7 trillion was poured into the economy over 4 or 5 year period, we saw housing recover. Because when you have more dollars chasing the same amount of product, then you've got more money chasing it. And when everybody wants it, well, they're going to pay more for it because they have more money available to do it. And that is how we got out of the last recession. That's how they're trying to get out of this one. Only more. We did that much stimulus in just a couple of months. It took years before. So it's concerning. But when we just look at home prices during past recessions, we can see that in the best recessions in the past, housing was barely affected. And the average, in a lot of markets, barely affected. In the worst housing recession, which of course was 2008, everything got hit hard, but that was a housing recession. That was a bad lending recession, bad lending to housing. So it was 100% housing's fault. It got hammered. This time it's not the case. If it's the opposite. It's been solid, very solid. So if in the past the average, home prices, weren't hit that hard, in those past recessions, we didn't have $7 trillion or unlimited stimulus being poured into the economy. We didn't have that. We only had that last time. So this time, they're going all out. And usually what happens is asset values go up because more money's chasing it. And the best way to explain that is, like, imagine you have a room of really hungry people and they all have $20. And somebody brings a lasagna in, and there's 20 people and there's 10 pieces of lasagna. And, you're gonna everybody wants that lasagna. Well, what if all of a sudden now everybody has $20 more in their pockets? They have $40. Are they still gonna say, no, that lasagna is only worth $20? No, they're going to pay $40 because they're hungry, and because now they have it. There's more money thrown into the economy. They're not going to just go, well, yesterday it was $20. They're going to say, no, I'm hungry. So it's the same when you have this much stimulus in the housing market. People are thinking, if I'm stuck in my home and this is the new normal, I want a nice house. And now that rates are low and I can afford it, I don't really care what the price of the house is. I just care what my payment is and if I can afford it. So that's why it's likely, and that's why we've seen prices go up. It's very likely. A lot of the concern has been, but there's been so many job losses. But when we really look closely at who lost jobs, it's young people. 60% of the leisure and hospitality workers were 34 years old or younger. Many were very young and probably not owning homes, probably renting. Again, coronavirus pandemic threatens low-wage jobs. 77% of the job losses were in the $20,000 to $25,000 range. Over 70,000, and again, this is in April, so things have changed, but it was over 70,000 not hit as hard. So I will get an updated chart on that of where we are today, but it changes every day because there's so many jobs that have been created and jobs are coming back. So we'll have a better idea next month. And what we know is the government controls 61% of mortgages because they're government backed, so many, Fannie and Freddie. And this is just, again, another chart showing that this is very high risk would be red. Look how many red high risk loans before 2007. You just barely see any today. Lending was so strict. And we did have some high risk FHA, but overall, the high risk is low. So there is some risk with FHA, but it's government controlled. And what we've seen is the government saying, you know what, we don't really want to see a bunch of foreclosures, so we're going to do whatever we can. We're going to give forbearances. We're going to make it work so that people don't lose their homes and that we don't have a bunch of foreclosures. So because so much of these loans are government controlled, they're controlling it basically. And here's just showing how much home equity we came into the pandemic with. So housing was really strong, high home equity, low fixed rate mortgages, really tough loans to get. Prices had gone up and people had bought their homes and saw values go up, had low payments. So they're just not in a big hurry. It's not like their loans are adjusting and suddenly they can't afford that payment. It's a very different scenario than last time. And the biggest thing is, and this is something, the most important thing to pay attention to besides what the Fed is doing, besides all the stimulus, the other thing to look at is supply and demand. So if there was a ton of homes on the market and the Fed was still doing all the stimulus, it might not matter as much, especially if people didn't really want those homes. But if the demand is there and the supply is not there, so you've got low supply and high demand and a bunch of money being thrown in, well, there's really only one way that goes, and that's usually prices up. So we went into this, as you can see, already with really low housing starts, new home starts. Back before, we were building too many homes, and they're just, people were just buying them for second, third homes because they could get loans so easily. Well, that came to a screeching halt, and a lot of people came into this thinking we were millions of homes short of what was needed. Now, because so many builders just weren't sure what to do, they just stopped. They stopped building, so inventory got even less in the new homes. So we're going to even see fewer housing starts with more demand. So when you compare it to the past, the 2010s, we had about half the housing starts that we have in the past. So already came to this with way low supply. Yet at the same time, we've seen our population grow. So more demand, more household formations, and just less supply, less people wanting to leave their homes, less on the market, but more people really recognizing they want a home. They want to move out of apartments and condos and get into a single family home with a yard. And again, demographics, the largest population, really these millennials, these are the people forming households, having babies, wanting those yards. It's a very large population. But then you've also got Gen Z, big population. My daughter just rented her home for San Diego State with a couple of friends for the fall. So they don't get to live on in student housing. They're living in little houses near colleges with their friends. Even if they're not even going to class, they're just doing it online, but they want to be together. So even this age, they're tend to be renting homes. Pre-COVID homeownership rate, so really dropped after the housing recession, started to pick back up. And now the question is, what's next? Will we see more homeownership or more people renting, but renting homes? I showed this last time, but I thought it was worth looking at. Q1, look at lots of negatives in the gross domestic product, but look at residential up 21 when everything else was negative. That's very telling, isn't it? Very telling. Our industry is the winner this time around. Man, we were the big losers. We ruined the world in 2008, but this time around, we are the winners. And this is the slide I want to show because this is really important based on what the Fed is doing. The dollar has been losing value ever since the Fed came into existence in 1913 because the Fed has the ability to print money. The US government isn't allowed to print money. So the Fed came in, it's basically the banking system, can print money and lend it because the Constitution says we can borrow money, we just can't print it. But the banks can print it and we can borrow it. So the Fed came in, made that really convenient for politicians. Now they can offer all the programs they want to get reelected and keep their constituents happy. And the Fed can just print money and lend it. What isn't explained in this is that it's a silent tax because we, the people, pay that back. So you think, oh, we just lowered taxes, but we really didn't. We've really increased taxes for everyone because of the declining value, creating all this money, all these stimulus checks, all that's gone out to the businesses. And, it's helpful for sure. What people don't understand is that's borrowed money that will be paid back or defaulted on or a new currency, whatever it is. The dollar value is losing value every day, and especially now with all the money printing. But what does that do to assets? It's like I said, that the pizza or whatever, the lasagna didn't become more valuable. It's just that because people had more money and they really wanted that lasagna, they're going to pay more for it. So asset values, house prices, the intrinsic value hasn't really gone up. It's just that more dollars can chase it. And the dollar purchasing power has gone down, so you need more dollars to pay for it. So in a time like this, when so much money is being printed, it's really nice to have your money, to have assets that will increase in value as the dollar declines. And I think that's partly why we're seeing so much money going into real estate right now. Again, inventory down, I already showed that. Now onto positive things. I mean, I just wanted to show this because it can get a little bit depressing with all the news with cases going up and stuff, but I did want to show that there's 130 possible vaccines in development all around the world. So we're not the only country dealing with this, and we're not the only country with smart people. And for the first time ever, we have the most brilliant people in the world coming together to find a solution to this. And they're coming together through Zoom calls, just like we are. And they're working together. There's people who've met who never knew each other before until now, as they find solutions. So I know India is on the verge of, I think they've already created a whole bunch of these vaccines because they're so sure it's going to work. It hasn't even been approved in India. So lots happening and something to pay attention to. I'm not a big vaccine person. I'm cautious about it. I don't know that I'll be the first one running out. I'd probably rather just sit at home and wait. But for those who want it, there are a lot of options, coming out. So more good news. Like I said, in spite of all the bad news here in Texas, there are nearly 481,000 jobs available. Again, this was in April, but this is just an example of the kinds of things that you weren't really necessarily seeing out there, that jobs have been created. Detroit, look at that, job openings. There was so much talk about the auto industry shutting down, and yet look at that, there was job growth, job creation as well. John Burns does surveys, and in their survey, they ask landlords how things are going, and you can see single family rental, 62% said that that business has been the same, and 28% said it's decreasing, 10% said it's increasing. So that's the largest one there on all of these different services that's just basically staying the same. American Homes for Rent, I showed this last time, they took a pause to see how things were going and kind of like us said, oh, kind of looked left, looked right, said, looks like everybody's wanting to rent homes right now. So they are picking up activity and planning to get into acquisition mode in a big way. And so are we. I mean, we just did a webinar on Florida recently. I just couldn't believe this. I couldn't believe that our teams were able to put together a package like this for our members. $159,000 brand new home in Ocala, Florida, in an area that has been traditionally a pretty sleepy little horse town, but is growing now because it's so affordable and it's More and more people can work anywhere. They can work from home. So $159,000 home that rents for $1,500. That's almost a 1% rent ratio on a new home. That is incredible. That's incredible. So that's why these are flying off the shelf. We've been busier than ever at RealWealth. I think 17 new contracts just last week, and you can see why homes like this. I mean, that's just amazing when you see the kind of demand that's out there. And the property manager said they've got a wait list for people who want these new homes to rent and to buy. So really interesting. I wouldn't have expected it. If you asked me in March, I wouldn't have known what to say. So we're very, very happy that our industry is a hot industry this time around, and that we are oftentimes, when housing goes well and when new construction goes well, it boosts the rest of the economy. And that may be why the Fed is putting so much money into revitalizing the housing market. I mean, that's where so much of the stimulus is going.